Basically, there's a lot of interest in the Wyckoff course, and a lot of folks want to learn how to trade. So maybe that's because of the market is. It's a lot of opportunity, really a lot of opportunity. It's a tremendous amount of opportunity, and basically you get trades every day. And I'm not even talking about day trades, swing trades, and every other like stock and group. Day trades as well, and more active stocks because a lot of folks are at home and they're just buying stocks. Um, anyway, so I'm going to start going over the Wyckoff course. I have a number of subscribers. Like I'm not really trying to do the YouTube thing, but I thought maybe it'd be a good idea just to have the entire course, like go through the whole course, explain what it is, and then y'all can kind of uh, follow along. Uh, anyway, so I'm going to start with the Wyckoff course and explain it. So this is an opportunity to understand what the material means and basically learn how to trade. In the Wyckoff course, I mean, to make it really simple, what are you trying to do, right? To say that I'm just trying to learn how to trade is very generic. Um, Although that is an objective, there has to be more specifics. And if you were to sum it up, it's the idea is to learn how to trade springboards. I mean, that's, for lack of a better word, strategy. And when I said springboard, I didn't say spring. Spring is different maneuver, which also is, if you know how to, know what it is, it's profitable. But the idea of the Wyckoff course, or what he says is, learn how to trade springboards. Springboards happen right before markup phase. And it doesn't need to be like the entire phase. It can be at the end of a pullback, right before the next rally. The market is again on a springboard. Alright, so right before the rally and right before the entire markup phase, from accumulation into markup phase, markets go on a springboard. And right before end of the pullback, right into the next rally, markets are on a springboard. So being able to identify those points, that's the skill. That is the skill. And then obviously being able to coordinate like the higher time frame with the lower time frames, looking for the entry, which is risk to reward is like 1 to 12 or like 1 to 10. That's, I mean, we're not even talking about 3 to 1. The whole idea is if you know how to use the lower time frames, your risk to reward is massively in your favor. That's the whole point. That this is why he was using 5-minute intraday charts to enter. Anyway, so I will start by going over the types of charts and then going over some studies and stuff like that. So we'll just start off here because the rest of it before page 42 is just, I can't go through it because it's pointless for me to go through it. It's not really learning. It's just kind of like an intro. And he just says, do the course over and over again because then it gets impressed in your mind, and that's a very important point because a lot of folks, they go over the course, but if you ask them, you want to be able to understand and kind of impress it to the point where when you see a certain condition, you can kind of even link it to what you've learned. Alright, so what is recorded? Vertical charts, what do they do? This table here tells you what chart you use, why you use it. So what is recorded, what you figure out, and what it indicates. So what is a vertical chart? It's a bar chart or a open high low close chart. What it has is price movement, high low close, right? Why is that important? Obviously the high low close and the range is very important. All right. Because it can identify the activities increasing, decreasing, dull, etc. And deductions from that bar chart. You indicate supply and demand, points of resistance and support, markup and markdown. You get all this from vertical charts, right? Lines of support and supply, change in stride and progress of movement. Now, a lot of people have to understand what the stride and progress is. Uh, the concept of speed in Wyckoff is a derivative of time and price, meaning the factors of the data that you get is what? Time, price, volume. But if you take a look at time and price, it has a derivative on a chart. What is that derivative? It is speed. So when the speed increases, the market is rallies briskly. When the speed is very bad, like it's an obtuse angle, what happens is markets are having trouble. There's a lot of effort. There is dullness. So we'll get into all those concepts and how to apply them later on. So what does this tell you? It tells you the trend or the direction of the price movement. Volume. This is also very important to understand. I'll be going into this a little bit later, but the idea here is volume. I've seen a lot of things about volume. Oh, that this is some type of gasoline for the market or some shit like that. Um, so we'll be going into that. Intensity of trading. So intensity, increasing or diminishing pressure, the low volume tests. All right, so pressure, very important, of supply and demand. Buying and selling climax, absolutely critical. You'll see how critical this is. And what is this telling you? It is telling you when to buy, when to sell, and when to close out. Buying, selling, and closing. I mean, what else? And what is this? A function of volume and price. Okay? So price and volume telling you when to buy, sell, close out. Alright, volume is giving you indication of climaxes. Intensity of trading and increasing or diminishing pressure. Pressure up, pressure down. Alright? It's in a way you could also say it's effort, but I'm not going to get into that. Time is the speed of the advances and declines. The speed is very important. Duration or accumulation or distribution. The duration of accumulation or distribution. Duration is very critical because later on when you do wave charts, it's going to tell you that this is a major factor. A lot of time, even volume will not be as clear as duration. So you'll see why time is a factor. So speed, I explained, is a function of time and price. It tells you whether the market is very active or dull. And all of this tells you, buying, selling trend, where to place orders. The figure chart tells you point of support, resistance, markup, markdown. I mean, if it's just going up, the best opportunities are the one with nice bases, stuff like that. Accumulation, distribution, lines of support, supply, markup, markdown. Probable distance, both a group and a market can move, not just a stock, a group and a market. It's really important to understand these things because if you have a group in your favor with a nice base, I think it's favorable. Probable extents of importance of accumulation or distribution. Basically big base. So imagine a box, right? There are multiple ways to do calculations on where the market's going to go. One way is to do it across, like what he does, Wyckoff. He goes from left hand side to right hand side and counts, right? The other way, and imagine just a rectangle, is to do it by width. Alright, now that methodology, he does it by length, but there are other methodologies that do it by the width of the box, meaning how big is the trading range. So imagine a box, length and width. Wyckoff, he uses length. Other methodologies use width. Again, another methodology will take the initial impulse and do measurements. Another methodology might take a look at the impulse, meaning the rally and the reaction, and then do a calculation based on cycles. So there's a lot of things there. But I find that many times, like if you on markets that are very small or very large, you have to keep on playing around with the box size. Determining calculation targets by width is not a bad thing. It's pretty damn good. and I've used it. In fact, another trader, I think Alan Andrews, used to do targeting. His targeting used to use median lines, but he also used trading ranges. A lot of folks don't know that. He uses trading ranges, and he was able to target using the width of the trading range. And I like it. Why? Because it works. Alright. Wave chart of tape reading. Price movement of market using sensitive leaders as an index. So supply and demand, sentiment of importance towards the market, critical points of support, development of accumulation and distribution areas, behavior of markets at critical points in the minor, intermediate, and major trend. These critical points are really important. These critical points, and I think what he's talking to are the tests right before. They're very low volume, they're low speed, they're low whatever, and then the markets go. So this area, these critical points are identified on wave charts. And of course this is support and resistance as well. I mean, just highs and lows, but the critical points in the trend is something else. Alright, because they tell you when the trend is going to change or when the trend is likely to change. Volume of trading. Again, he's using wave chart and he's talking about volume. Volume of trading on alternate buying and selling waves. Changes in pressure up or down. So when you're watching the volume on the wave, like the Weiss wave or this other wave volume, you're looking for pressure. Pressure up or pressure down. Pressure. I like this word because I think it means a lot. If you have a lot of pressure, you should have a lot of movement. If you have little pressure and you have a lot of movement, sometimes that's good, sometimes that's bad, and I'll go over that later. But the idea of pressure is really important, especially on breakouts. And changes of pressure up and down, I mean, I don't know. Quality and urgency of supply and demand by comparing volume with activity and time is very important. The quality, this is really important. Like, what is mean by quality? If you have, let's say you have 1,000 contracts traded, how do you know it's good quality or bad quality? 1,000 is your volume. This is where activity comes into place. Activity is, for lack of a better word, a derivative of volume, which tells you whether that volume came from strong hands or weak hands. How does it do that? By taking a look at the size. If you have 1,000 contracts traded, and you have a bunch of, let's just 30 lots, 40 lots, 50 lots, that's a good thing. If you have a lot of them that are just 1 and 2 lots, that's a bad thing. So those 30 lots, 20 lots, this telling you that those are bigger players versus the 1 and 2 lots that's telling you smaller traders, mom and pop. So what the volume of trading on alternative buying and selling waves, why Wyckoff used it was he looked at time and he looked at activity to help him determine whether the quality of the volume was good or bad. Alright. So first thing is volume, we're looking at it as pressure. Second thing is the quality and urgency of volume, meaning the quality of that supply, the quality of that demand, meaning how do you determine it? You determine it by taking a look at the volume and time and activity. Now let's say you don't have activity or you're not splitting the volume, right? By filtering the volume by lot size or by dollar amount or whatever. You could use time, because if you have a lot of volume and the thing is so slow and it's not making a lot of progress, it's obviously effort or dullness. So don't just think that high volume is, oh yeah, that's great. High volume relative to time meaning how much time did it take for all that volume to come out, and the other factor of activity, or the sub-factor of activity, which takes a look at the volume and splits it by determining the size of the trades within that volume. So a lot of folks won't really have activity, but I think you can just determine it by time, and the angle is pretty clear, and those bars are probably very small in range and shit like that. So anyway, activity or intensity of trading. Activity of bull or bear forces to attract a following on advances and declines, rallies and reactions. Activity or intensity of trading. Again, intensity of trading meaning those big, blocks coming in that are able to move price, or is it just one lot, two lot, one lot, two lot? So all of this is helping you determine turning points in the minor, intermediate, and major trends. It's not easy to do, but after I go over the wave chart study later on, or you could check a prior video where I examine it and just show what Wyckoff did, it will let you know how to do this, but I did it based on price and time. Time or duration of buying waves and selling waves. Speed. Character of the supply and demand, whether it's urgent, leisurely, timid, or aggressive. If it's rallying briskly, or is it slow, dull. So this is the responsiveness of the market to buying and selling impulses. How responsive is it? Price change from wave to wave, net gain or net loss, changes in pressure up or down. So there's a lot to be said about this, but really it's better to show it. Alright, so I'll go over this once again. Price changes from wave to wave. Okay, what is a price change? It's just the amount up versus the amount down. So if there's more movement up than down, then it looks like a rally and a pullback, right? So that's the changes in pressure up or down. It's also pulling power, meaning supply versus demand, relative strength of supply versus demand from the angle of pulling power for price. Time is lasting power. That's how he describes it later on, and lasting power is really important. And also the turning points typically have very little time. They can't last. They're just 1 bar or 2 bars, maximum 3 bars, and they reverse. Activity, volume, again, pressure, and quality by comparing volume to time. You can do it based on volume to time. Comparing volume to time will tell you that the quality is relative to volume and time, even if you don't have the ability to filter. Alright, now having said that, let's go through this. Every up or down swing in the market, whether it amounts to many points or a few points, fraction point, consists of numerous buying and selling waves. They have certain duration. Duration is what? Time, meaning 15 minutes, 20 minutes, it's an hour long. They run just as long as they can attract a following. When this following is exhausted for the time being, that wave comes to an end and a contrary wave sets in. The latter may attract more of a following than the former. By studying the relation between the up and down waves, their duration, speed, and extent. Duration is time. Speed is basically is the move up quick or slow and sluggish. So it's basically time and price. And extent is like how long is the move. Does it go 5 points up, or does it go 10 points up, or does it go 1 point up? And comparing them with each other. So what are you doing? You're taking a look at time, speed, and extent, which is all what? Price and time. By comparing price and time factors of buying and selling waves, we are able to judge the relative strength of the bulls and the bears as price movement progresses. He hasn't mentioned volume yet. As all market movements, however large or small, are made up of buying and selling waves, the market does not rise and fall like water. in a tank. It moves by a sequence of waves. Alright, the small buying selling waves which occur in every stock market session run so many minutes. They are caused largely by professionals, and because they must have activity to make money. Right, the degree of success or failure is okay, nothing here. The small waves are part of larger waves which run several days. You can easily confirm the above by examining any chart. It is important that you know and impress upon your mind the numerous types of waves and various sizes. Inasmuch as this will help you to understand the market, you will therefore think in waves. It's really important to do this, to acquire this ability. A lot of folks think in terms of RSI and stochastic. You're not going to become a Wyckoff trader by thinking about it, in terms of MACD. When you are trading, looking for an opportunity to buy, watch for the down waves in the market and in your stock. Okay, so it rallies, watching for the down waves. Tick, 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 tick. After you've bought, you sit through a number of small, medium. So what's he saying? When you're looking for opportunity to buy, watch for the down waves, and then he just stops. So watch what on the down waves? Doesn't mention that. Instead, he jumps to after you have bought. Funny. They probably cut it out. It's pretty abrupt. Where is it? Where's my mouse? I can't find my mouse. There it is. And then he says, after that you sell in on the climax. That's what he's saying. Strong wave up, sell it in the climax if you bought. On the pullback, sell it in the climax. The waves of the market furnish a clear understanding into changes in supply and demand. By learning to judge all sides of market waves, you will gradually learn to spot the time when a rising market or rally and the time when the declining market or reaction has halted. There's such a thing as halting points, and I'll discuss that later. It's different from turning point, by the way. And about to reverse. These are the turning points. There's halting point also. I mentioned the division 2. So to be able to say when these turning points are occurring at the top of a market or important rallying point on the way down to the is the mark of a trader. So bottom line, you are specializing in turning points. As a Wyckoff trader, you need to be able to know what these turning points look like and be able to trade them. Remember the mark, so there's springboards, turning points, right? Two very important ideas. Both of them which folks are not talking about. Instead they're talking about like some other stuff. Every significant change in supply or demand is registered on the tape. When you have learned to analyze the market by its own action as recorded on the tape, then you will be proficient at the art of operating in stocks. So of all the things that are most desirable to know about the stock market, first is to be able to catch a top. And the other is to catch the bottom, and do that of major, minor, and intermediary trends. That is very hard to do. It's not easy, but there's multiple concepts that need to be understood. And then master this branch and subject thoroughly. It is vital, but there's one more step. You got to be able to go long at the bottom and short at the top, and you'll be able to do this. Alright, so he says long the bottom, short the top. You see? And being able to not only determine but to put a trade on at those points, that's really that's the point. Like, all right. So what do you want to do? For the average and more advanced students, the following is recommended. as a starting point. Like, what's for the average student? Type of chart. You use the SPY right here as your index. Then you can use all of these. These are just different types of charts. So the group averages, the sectors. What is this saying? This is the SPY nowadays. This is the sector spiders, right? Industrial, utility, whatever. Then these are the industry groups, and then 25 to 200 stocks, and wave chart of tape reading. And I would say SPY. Then you want to, yeah, you want to start off with as few stocks as possible. You won't follow it if it's too many, unless you're professional. Because I don't know. And for futures traders, like, it's much simpler. You just say you have far fewer markets, right? So you'll be following the ES, gold, oil, right, and yen, euro. In the following forms: 1.3 point, 1.3 point, 1.3 point, 10 point figure. Alright, and a continuous line. Nah, you don't need a continuous line. Continuous line chart, all it does is just draws a line on the closes. That's all it does. So it's pretty obvious. It's just drawing close to close to close. It's like a wave. The above portfolio can be expanded. He's big on weekly charts as well. He's okay with volume, but weekly includes volumes. Monthly does not include volume. So I mean, like, you don't need the monthly volume, but the weekly you should have volume. Alright, I'm done. Next video I'll probably go over all this charting. And that's all.